Hey folks, welcome back to the channel. This is Jason, certified financial planner and host of Fighting Words Financial. Today I'm making my first video at nighttime, which means there's no natural light coming in from the window. I have no idea how this is going to look, but we're going to find out. So anyway, we're going to talk about today how to lock in your stock profits with put options. And this is kind of a beginner's guide. We're not going to cover everything today. There's going to be a lot of information left out, and I'm going to give you guys some reading materials afterwards. So let's talk about options. This could be useful to a lot of investors this year, especially after all the monster gains we've had in certain sectors. But let's go over a few things first. This is not a video about some super secret options trading strategy guaranteed to make you millions of dollars. Number one, I don't do videos like that. And number two, I sure hope you don't believe the videos you're watching on those, because that's mostly not true. Too many videos that I see on YouTube are about complex option strategies that, to be honest, are too much effort and probably don't really work better than a buy and hold strategy does over time. I'm going to let you guys in on a secret right now that's not really a secret to anyone who actually sells options contracts. 80% of all options contracts are going to expire without being exercised. And the only money that actually changes hands is the premium that you paid to the contract seller. So this is a simple video about using put options on a particular stock to lock in gains. By using a put options contract for what it's actually intended for, the original purpose, which was to guarantee the right but not the obligation to sell a particular stock at a future date at a specific price called the strike price. By the end of this video, I think you're going to understand why you might want to use a put option, particularly this year, and how it could help you. It can help work to do a couple of things, really these three things. It can help you guarantee an exit price on a stock. It can help you ride out some price volatility in the near term, or it can help you stretch out your holding period on that stock while protecting your gains so you can take advantage of preferential tax treatment on long-term capital gains. A lot of us have giant gains this year in certain sectors of the market. We're a little bit nervous going into the new year. Some people are considering selling, or they have a stop loss on their stock, and that might actually cause some adverse tax consequences, and we're going to talk about that later on in the video. So options contracts, at least the concept of options contracts, have a really long and storied history going all the way back to when they were established in ancient Greece. Now, you guys know that I'm a nerd, and I'm going to spare you the terribly riveting story of insurance contracts in ancient Greece that I only now realize after many attempts to explain to my friends and to total strangers that it's only of interest to nerds like me. And for that alone, you should definitely like this video and subscribe to my channel, because I spared you from that. But if you really want to read about the remarkable story of risk, I'm going to leave my first ever Amazon affiliate link in the description to a book called Against the Gods, The Remarkable Story of Risk. Of course, I get paid a small fee if you decide to buy that book. All right, folks, why am I talking about options right now? I am, after all, a rational, long-term buy and hold investor and not a frequent trader. My holding period on a stock when I purchase it is theoretically forever. I never actually plan to sell anything. I only do once it becomes a giant portion of my net worth. So rational as I may be, and as experienced as I may be at investing, I still get worried about the possibility of losing all of the gains I have in a stock, or all those gains melting away. I'm human just like you guys are, and there's always going to be the possibility of some unforeseen adverse event that's outside of my control, outside of your control, that can really destroy the value of a stock. You know, something like Congress doing something abysmally stupid, or accounting fraud with a company, or I don't know, a global pandemic. One of the most common things that you'll frequently hear a frequent stock trader say, or a new investor say, is make sure you lock in profits, or I'm not worried, I have a stop loss order on this stock. One of the things that many investors don't realize is that you can lock in profits using options as opposed to just selling the stock or using a stop loss order. This can prevent a lot of unnecessary taxable transactions that can eat into your return over time, especially if you really do want to be invested in the stock for the long term, but you're just worried about losing your gains. So this part of the video will focus on how locking in profits is done and when it may be a useful strategy for you. By the way, if you do end up wanting to buy an option contract on your own, you're going to have to apply for options trading privileges on your account, and you're going to need to do that with your broker a few days before you want to make a purchase. Your account doesn't automatically come with those privileges. The most common way to lock in profits using options is by purchasing an out-of-the-money put whenever you'd like to lock in that profit. A put option contract is a contract that you purchase through your brokerage account that trades with a floating value, kind of like a stock does. And when you buy it, the amount that you pay is called a premium. It gives you, the owner, the right, but not the obligation, to sell a specified amount of an underlying stock at a predetermined price within a specific time frame. This predetermined price that the buyer of the put option can sell at is called the strike price. This strategy is appropriate in a few cases. An investor can use put options to lock in profits at any time that they'd like to, but they can be especially useful if the stock is maybe expecting some volatility in the future. So let's just go through a hypothetical example here. Let's say you're in an EV stock and Congress is debating on whether or not to end electric vehicle subsidies. And you think there might be a hard correction in EV stocks if this happens, and they might never recover to their former glory. But it might not happen. I mean, who can predict what the idiots in Congress will ever do, and the stock might just continue on its bullish trend if Congress decides to do nothing. So you can simply purchase a put at whatever point you'd like to lock in profits. So let's say in this hypothetical situation that you prepared ahead of time and you bought a put. So Congress goes ahead and decides to end the tax credit, and the stock drops like a rock below the strike price at which you bought the put contract. You'll have the right to simply exercise that put option and sell the stock at the strike price that you originally purchased. So let's go through an example right now. So here's an example that I'm going to show you guys on my screen. Let's say it's December of 2020. Sally is an investor who is long on a hypothetical electric vehicle stock. Let's just call it NIO. It's allegedly called NIO. She's been long since April 1st of 2020, when she first purchased 1,000 shares of NIO for a price of $5 per share. So let's say NIO last traded at about $45 per share. She has some pretty large gains and is nervous that the price is going to fall, and she thinks that it's not going to recover if Congress ends EV subsidies. She'd like to hold on to the stock if it continues to rise, but she's afraid of losing all of the gains that she's made so far. The real big problem is that she's only held the stock for 9 months, so if she sold it now, she wouldn't get long-term capital gains treatment on the stocks, and the gains would be taxed at ordinary income tax rates, and those gains are so large that it might even push her into a higher tax bracket. Sally would like to lock in a large portion of her profit and delay the sale of stock until after the 1-year mark to avoid negative tax consequences. Since she's long this hypothetical stock called NIO, she knows that she's going to need to lock in her profits using put options. The put options act sort of like a short-term insurance policy. She would like to lock in all of her profits, and she could, but the price of an option locking in anything close to the current price of a stock would be so expensive that it really might not be worth it. So here's some information that I pulled from the current NIO options chain. We're looking at April puts. Monthly puts always expire, by the way, on the third Friday of the month, which this year is April 16th. I'm actually 2021, that's going to be in April 16th, and we're looking at options that expire in April of 2021. And let's say that because of the high cost of an option that's close to the current price, Sally decides to settle for locking in a portion of her gain for what she believes could be a sort of worst case scenario. She decides to purchase an April put with a strike price of $31 per share and at a price of $3.10 per contract, which it's really $3.10 per contract. A contract is 100 shares. She wants to hedge her entire position, so she buys 10 contracts at $3.10. This is what that really means. So $31, the put option she purchased, she can sell all of her 1,000 shares at $31. That is the strike price. If NIO drops to or below $31, that's the price she's able to get. So we're going to subtract out $3,100 because that was the cost of 10 options contracts. So it's $3.10 per share. Each contract has 100 shares. She bought 10 contracts. So the difference is going to be $27,900. That's the price locked in after the difference in the strike price and the premium paid. Additionally, you need to subtract out her initial purchase. She paid $5,000 for the initial 1,000 shares. So at this point, she's locked in $22,900 of profit above the $5,000 that she paid for the contract. So even if Congress does something really stupid like, I don't know, banning electricity, or Neo headquarters gets hit by an asteroid, or you have a global zombie pandemic before the put option expires on April 16th, because that's exactly what I'm waiting for. If none of that happens though, and the option expires, Sally is out $3,100 for the premium that she paid for the 10 options contracts. Now that premium isn't completely money just thrown down the drain. It gets added to the cost basis of the stock she purchased, and she isn't taxed on that amount when she finally goes to sell the stock. Now this, guys, is a very simple primer on how to use put options as a tool to protect your gains. It may be useful to anyone that has a ton of gains this year, like many of you do, and you want some peace of mind regarding an exit point, or you want to be able to push out the sell date of your stock until after that 1 year mark in order to take advantage of preferential tax treatment on long-term capital gains. Now, there's a lot more complex strategies out there like options collars and a bunch of other things like straddles and all that stuff. And you can use all that to both lock in your gains and offset the cost of options. But for the sake of brevity here, I'm not going to go into that in this video. It could take forever. But I am going to advise you guys that before you dip your toes into the options world, you really need to do some reading. And I'm going to leave another couple of links here in the description below to good books on that subject. And remember, folks, also, this is not a recommendation to buy, sell, or hold any security. You have to do your own research. And it's particularly when it comes to options research, you need to do your own reading, and you can't rely on what you hear on a YouTube video. So read those books, guys. Study up on this before you ever decide to do this. So in summary, using options to lock up profits is a simple alternative to just selling the stock and realizing a taxable event, or just gritting your teeth and suffering through some sleepless nights. They can give you the ability to ride out some volatility swings with a defined exit point and help you to get better tax treatment when you finally do decide to sell. Anyway, folks, these are just my thoughts. You can tell me how wrong you think I am in the comments below. I look forward to hearing from you. Thank you very much.